In today's video, I'm going to teach you how to diversify your portfolio with Wealthfront. Diversification might sound like a finance buzzword, but it's a fundamental strategy for anyone looking to manage risk and optimize returns across their investments. So, let's delve into the essentials of diversification and how you can apply it to your own portfolio using Wealthfront. First up, it's important to understand what diversification is and why it matters. Essentially, diversification is about spreading your investments across a variety of assets to balance risk and reward. By not putting all your eggs in one basket, you're less likely to experience severe fluctuations in your portfolio's value. A well-diversified portfolio should help you over the long term by cushioning against adverse market movements. Now, upon visiting the Wealthfront blog, you'll find detailed articles about diversification written by experts like Fang Rui, CFA, and Alex McCalca, PhD. They break down the principles of diversification and its significance, providing a robust starting point for understanding the topic. These resources emphasize that diversification involves both the quantity and variety of assets you include in your investment portfolio. So, what specifically makes a portfolio diversified? In simple terms, it's the blend of different kinds of investments. Rather than concentrating in one sector or type of asset, a diversified portfolio includes various asset types like stocks, bonds, and real estate. Each asset class has its own level of risk and potential return, so mixing them properly can provide a more stable growth pattern over time. Next, let's talk about how to go about diversifying your portfolio. A solid strategy involves three core dimensions: across different types of assets, across various asset classes, and over different time horizons. This means incorporating a wide range of investments in your portfolio, each bringing a unique risk and return profile. Wealthfront, with its automated investment services, can significantly simplify this process for you. When diversifying, start by diversifying across assets. This means acquiring a mix of stock and non-stock investments. Through Wealthfront, you can conveniently access broad index funds which are diversified by design. These funds invest in hundreds or even thousands of individual securities, letting you spread risk across a wide spectrum of companies. Next, diversify across asset classes. This involves balancing your investments in stocks with bonds, real estate, and other sectors. Each class usually reacts differently to market events, which further stabilizes your portfolio. Wealthfront's allocation suggestions are based on modern portfolio theory and can help ensure a well-balanced investment strategy tailored to your risk tolerance and financial goals. Finally, consider diversifying across time. Investing consistently over regular intervals, a strategy known as dollar cost averaging, helps mitigate the risk of market timing. Rather than trying to predict market highs and lows, you invest the same amount at steady intervals, which can reduce the impact of volatility. By applying these principles, you diversify your investments effectively, positioning yourself to build long-term wealth. Wealthfront's array of automation tools aids in navigating these strategies with minimal complexity, allowing you to focus more on your financial future rather than the intricacies of market management. Remember, while diversification doesn't guarantee profits, it's a vital aspect of a well-rounded investment strategy.